Most Americans assume the IRS is trying to take their money, but if you read the tax code closely, you'll notice something striking. There are full sections written to pay you for making certain investments, not tax breaks, not loopholes. The government directly gives you money when you put your dollars into the kinds of things it wants built. I am going to show you exactly which investments the IRS pays you to make, how much they pay, why 90% of Americans never touch even one of them, and how the wealthy have quietly used these strategies for the last 100 years to build the kind of generational wealth most people think isn't possible unless you're born into it. By the end of this video, you will understand the tax code not as a tool of oppression, but as a menu that Congress wrote to reward specific behaviors. And if you simply choose the items from that menu, the IRS will help fund the kind of life the government expects. Let me start with the single most important idea in the entire tax code, because if you understand this one thing, everything else becomes clear. The tax code is not built to be fair. It is built to encourage behavior. Each line item in the tax code was written by Congress to steer money towards something: housing, energy, business, investing, retirement, education, charity. If you do what the tax code wants you to do, the tax code will subsidize you. If you ignore the tax code and only work a W-2 job and collect a paycheck, you end up paying one of the highest effective tax rates in the country. The average W-2 worker pays roughly 25 to 37% of their income in federal taxes, state taxes, payroll taxes, and hidden costs. The average wealthy American pays closer to 15%, not because they have better accountants, but because they understand the code is a menu and they chose the right items. Now, let me walk you through the investments the IRS helps you with. The first one is so straightforward, it shocks people when they finally understand it. Start a business. The moment you have a legitimate business, every economic relationship in your life shifts. Every laptop you buy, every phone you use for work, every trip you take to meet a client, every meal you eat while talking to a prospect, every mile you drive between appointments, every subscription you use to run your operation, every dollar you spend learning your industry, everything becomes deductible. And I am not describing some tiny share. Under Section 179 of the tax code, you can expense up to $1 million of business equipment in the same year you buy it. A regular employee making $100,000 pays taxes on $100,000. A business owner making the same $100,000 may be able to deduct tens of thousands of dollars in expenses before the IRS receives anything from that money. That is not a trick. That is the tax code functioning as written. Congress wants more small businesses in America. They wrote the rules so that the more you invest back into your business, the less you pay in taxes. And it grows over time. A business owner who reinvests heavily can often operate at a paper loss for a while still building real equity and real cash flow behind the scenes. That is the dynamic. The second category the IRS encourages you to consider is real estate. And I want to spend extra time on this one because this is where many wealthy families build lasting wealth. When you buy a rental property, you may be able to use depreciation. Here's the basic idea. The tax code treats the physical structure of a building as gradually wearing out and losing value over time. For residential property, the assumed recovery period is 1 to 2 years. For commercial property, it is 39 years. So the IRS allows you to take the building value, divide it by that number, and claim deductions against income each year. A $500,000 rental property with a $400,000 building portion can produce roughly $14 to $500 in depreciation deductions each year for nearly 3 decades. That is $14 to $500 of income the IRS assumes you did not earn, even though the property is still generating rent. But here is the part that surprises most people. The property is often not truly losing value in the way the tax concept suggests. In many cases, it is appreciating. So you collect rent. You build equity. You watch the property appreciate while the IRS still reduces your taxable income by tens of thousands of dollars each year based on a depreciation method that is not necessarily a real-time reflection of market value. This is commonly referred to as a phantom loss. It is a deduction on paper that can reflect a gain in real life. It is one of the most striking accounting outcomes in the tax code. Now, pair that with something called a cost segregation study. This is where a professional engineer reviews your property and identifies components that may have shorter useful lives than the building as a whole. Things like carpeting, appliances, light fixtures, landscaping, and parking lot surfaces. Those components may be depreciated over 5, 7, or 15 years instead of 27, which can let you accelerate depreciation early in ownership. A smart investor with $1 million rental may be able to claim significant depreciation in the first year alone, sometimes in the range of $150,000 to $250,000 if eligible and properly documented. That is a major deduction against active income if you qualify as a real estate professional. And then we get to the 1031 exchange. Section 1031 of the tax code says that if you sell an investment property and reinvest the proceeds into another investment property within a defined time window, you generally do not have to pay capital gains tax on that sale right away. You can do this repeatedly. You buy, sell, exchange into another qualifying property and continue. So long as you follow all rules, you generally do not pay that tax at the time of each exchange. And when you die, your heirs may inherit the property with a stepped-up basis, which means the unrealized gains built up during your lifetime may be wiped out for tax purposes. The government may allow wealthy investors to build and transfer real estate holdings without paying capital gains tax at each stage. This is not illegal. It is not hidden. It is set out in the law. Most people simply do not read the code. Now let me move to the third investment category that almost nobody discusses, and once I explain it, you'll see why the wealthy stay quiet about it. Energy. The federal government wants American energy production. They want it so badly that they created tax incentives that can feel almost unbelievable when you first hear about them. If you invest in oil and gas through a working interest, you may be able to deduct a large portion of your investment in the first year through intangible drilling costs. Let me translate that into real numbers. If you put $100,000 into an eligible energy project, you might be able to write off up to $80,000 against active income in the first tax year, depending on the facts and eligibility. Not spread out, not delayed. In the first tax year, this is one of the investments in the tax code that may allow deductions against W-2 income, and it is designed for that purpose. Congress wants private capital to fund American energy. Clears throat. And if you prefer renewables, the solar investment tax credit can give you 30% of your installation cost back as a direct credit. I want to clarify what a credit is because a credit and a deduction are different. A deduction reduces taxable income. A credit reduces your tax bill dollar for dollar. If you owe the IRS $20,000 and you receive a $10,000 tax credit, your bill drops to $10,000. It is money off the top. So if you install a $100,000 solar system, you may receive $30,000 as a credit, reducing what you owe in taxes, and you still own the solar system that generates electricity that can either lower your bill or be sold back to the grid. That can be the government encouraging energy ownership. There are also credits for wind energy, geothermal systems, battery storage, and potentially for buying certain electric vehicles. The Inflation Reduction Act, despite its name, included major energy investment tax credits. It just was not marketed widely to everyday consumers. It was structured to be used by companies and investors who know how to take advantage of it. And that is the pattern of this entire video. The tax code rewards people who know how to use it and overlooks people who do not even know it exists. The fourth investment category is retirement accounts. And I know everyone has heard of retirement accounts, but almost nobody uses them in the best way. A standard 401k often allows deferrals of about $23,000 a year. In 2026, that is the standard employee contribution limit. But here's where it gets interesting. If you own a business, even a side business, you can open a solo 401k and contribute up to $69,000 in a single year. That can be about 3 times the employee-only limit. You contribute both as an employee and as an employer at the same time, and each dollar of that contribution can reduce your taxable income. A business owner making $200,000 may contribute $69,000 to their solo 401k and potentially reduce taxable income to $131,000, assuming a 32% bracket. That can translate to over $22,000 in potential tax savings in a single year, and it could continue each year you contribute. And then there is the crown jewel of the retirement system for many people, the health savings account. The HSA is one of the few account types in the tax code that can provide a triple tax benefit. Money may go in with tax advantages. Money may grow tax advantaged. Money may come out without tax when used for qualified medical expenses. Traditional 401k money may receive tax advantages going in and tax advantage growth, but taxes typically apply on withdrawals. A Roth IRA can offer tax-advantaged growth and tax-free qualified withdrawals, but contributions are often not deductible. An HSA is notable because it may combine those benefits. Now, here is the twist that many people never use. You do not necessarily have to withdraw funds for medical expenses immediately when you incur them. You can pay medical bills out of pocket, save receipts, let your HSA keep growing for years, and reimburse yourself later at a later time, following the rules. That means an HSA can potentially act like an additional retirement account with very strong tax treatment. Now, I want to go beyond the four main categories because the tax code includes smaller, less widely known strategies that can stack on top of each other and help savings compound. Let me show you a few that wealthy investors use that almost nobody talks about publicly. First, opportunity zones. This began in 2017 and it can be powerful. If you have capital gains from an investment and you reinvest them into a designated opportunity zone fund, you may be able to defer the capital gains tax on the original gain until 2026. And if you hold the new investment for 10 years, some or all of the gains on the new investment may be eligible for tax-free treatment. This was designed to direct private capital into economically distressed areas, but some wealthy investors have used it to build large tax-advantaged portfolios. Second, the Augusta Rule, which is Section 28A of the tax code. This rule allows you to rent your personal residence to certain parties for up to 14 days per year and potentially keep that rental income tax-free depending on the situation. If you own a business and you host qualifying meetings at your home, you may be able to collect rental income under the conditions of the rule without it being taxed and claim related business deductions as allowed. It is one of the cleaner and more underused strategies in the code, as long as you keep proper documentation and the rent is reasonable. Third, hiring your children. If you own a business and you have children, you can pay them a reasonable wage for actual work they perform for the business. Under current rules, children under 18 working in a parent-owned business may be exempt from payroll taxes in certain cases. And if their total wages are under the standard deduction, they may owe zero federal income tax. That means you can shift income from a higher bracket to their potentially lower bracket while the kids learn real skills. A family with 2 children may move tens of thousands of dollars per year from a parent's tax return to the children's, within the rules. Fourth, qualified small business stock, which is Section 1202. If you invest in or help found a qualifying small business and hold the shares for at least 5 years, you may exclude up to $10 million of gains from federal taxes, depending on eligibility. This is one reason many tech founders can owe very little federal tax when they exit, because they qualify under Section 1202 and exclusion rules. Fifth, step up in basis at death. When you die, your heirs may inherit assets at fair market value as of the date of death, not your original purchase price. That can mean capital gains built up during your lifetime may disappear for tax purposes for your heirs. Someone who bought stock for $10 a share and watched it become $1,000 a share over 40 years can pass that stock to their heirs with a new stepped-up basis. If the heirs sell later, the tax is generally calculated from that stepped-up basis. This is one way generational wealth can compound with less taxable transfer. Sixth, the Roth conversion ladder. You move money from a traditional IRA, pay tax during years when your income is lower, convert it to a Roth IRA, let it grow tax-free, and then withdraw it using the Roth rules after the required holding period. Used correctly, this strategy can help high-income earners build Roth balances, even if they could not contribute directly to Roth early in their career. Seventh, the research and development tax credit. If your business spends money on developing new products, improving existing products, testing new processes, or building custom software, you may qualify for a federal R&D tax credit that can be worth up to 20% of eligible expenses. This is not only for pharmaceutical companies or semiconductor manufacturers. A small software company, a fabrication shop building custom work, a food and beverage business developing a new recipe, or an engineering firm building custom solutions may qualify if they meet the requirements. Many small business owners and even some accountants do not know how to properly claim it, but businesses that do know how to use it may legally reduce their tax liability and reinvest more into operations. Eighth, the backdoor Roth IRA. If your income is too high to contribute directly to a Roth IRA, You can still potentially contribute to a traditional IRA on an after-tax basis and then convert it to a Roth IRA. This can be legal under IRS guidance. It can let high earners build Roth assets that grow tax-free and are potentially insulated from future tax increases each year, so long as they follow the rules. Niche strategies exist, and many people never hear about them. Ninth, the Mega Backdoor Roth. This is an expanded version of the backdoor concept. If your employer's plan allows after-tax contributions and in-plan rollovers or conversions, you may be able to contribute an additional large amount per year, often around $46,000, into a Roth account on top of regular pre-tax or employer match contributions. This can significantly increase tax-advantaged retirement growth over a working career, but it depends on plan features and proper compliance. 10th, historic rehabilitation tax credits. If you buy and restore a certified historic building, you may be eligible for a 20% tax credit on qualified rehabilitation expenses. For example, if you spend $1 million restoring a historic property, you may receive a $200,000 credit as a reduction of your tax bill, subject to program rules. Combine that with depreciation, cost segregation, and qualifying status, and some investors can structure deals around historic properties with strong tax benefits. 11th, low-income housing tax credits. This is usually not for the average person, but if you have the capital to invest, the government may provide tax credits to encourage the development of affordable housing. Credits can be substantial over multiple years, potentially allowing investors to recover a large share of their investment through credits while they still hold an interest in the property and collect income. 12th, Section 529 plans with Roth conversion. Starting recently, unused money in a 529 education savings plan may be rolled into a Roth IRA for the beneficiary up to $35,000 in total under specific rules. So if your children do not use all the money you saved for education, it does not necessarily have to be wasted. It may be converted into a tax-advantaged retirement account in their name. You can fund a 529 early, let it grow for 18 years, cover education costs, and then convert leftover funds within the limits. That can be an intergenerational wealth transfer tool, with tax-advantaged growth at multiple steps. Now, let me walk you through an example showing how these ideas can stack, because this is the part that changes how people think about money. Imagine you are a business owner making $250,000 a year with no tax planning, considering federal, state, and self-employment taxes. You are likely giving roughly $80,000 to $90,000 to the government each year. That is more than 30% of your gross income before you get to live your life. Now, let me walk you through the same person using the strategies I described. You contribute $69,000 into a solo 401k. You put $8,000 into a health savings account. You buy a $300,000 rental property and claim roughly $10,000 in depreciation. You do a cost segregation study and front-load another $30,000 of depreciation in the first year. You pay your teenage children $12,000 each for legitimate work in the business, moving $24,000 off your return into their potentially lower tax bracket. You put $100,000 into a carefully evaluated energy working interest and deduct $80,000 if eligible under the specific facts. You use the rental rule and collect $28,000 in potentially tax-advantaged rent under the rule's conditions. Add up the deductions. You may reduce taxable income by around $240,000 if you qualify and document everything correctly. Your effective tax rate may drop from the mid-30s into the single digits. You may put somewhere between $50,000 and $70,000 back into your own pocket in a single year, with continued benefit if you keep following compliance strategies. All of it legal, all of it supported by proper documentation, all of it reflected in the tax law Congress wrote. And that is just year one. Now imagine that same person stacking these strategies year after year. The rental properties grow in number. The retirement accounts compound inside the tax shelter. The HSA grows into a long-term medical fund. The children mature with real work experience and Roth balances in their own names. The business may become more valuable because it is being reinvested into aggressively. 10 years from now, that business owner may have somewhere between $1 and $3 million in additional net worth compared with the version of themselves that did nothing and simply paid the standard tax burden. That is not just imagination. That is what can happen when you use the code as Congress structured it instead of only criticizing it. Now here is the part that matters most, and this is what I want you to take away. The reason most Americans never use these strategies is not that they do not qualify. It is because no one explains that the tax code is a menu of incentives. Your high school didn't teach you this. Your college didn't teach you this. Your employer didn't teach you this. Your financial advisor probably didn't teach you this either, because many advisors are trained to sell products, not strategies. So the code sits there, full of incentives, waiting for someone to actually read it. And most Americans never do. Congress uses the tax code to channel money toward the activities it wants more of: businesses, housing, energy, retirement, education, conservation, and charitable giving. Every one of those categories can act like a sign that says, the government will help cover part of the cost if you participate. The government is literally reaching into its pocket and saying, here, take some of this money if you follow what we are asking for. And most people ignore the signs and complain about how high their taxes are. The people who build real wealth are not necessarily the ones who work harder. They are the ones who read the instructions. The tax code is the instructions. You just have to stop treating the IRS like an enemy and start treating it like a rule book. Because once you know the rules, you stop playing defense and start playing the same game the wealthy have been playing for 100 years. And that is the game where the IRS can effectively help you. And I want to end with one more thought because it is one of the most important concepts anyone can understand about taxes. Most people think they pay taxes because they are being punished for success. They are not. They pay taxes because they have not learned how the system was designed. The system was built by people who expected you to invest in businesses, own real estate, fund energy, save for retirement, and build wealth. The system was built for participation, not passive observation. The moment you become an active participant, you can stop feeling like a tax victim and start feeling like a tax beneficiary. The IRS is not your enemy. The IRS is an incentives framework combined with enforcement. The sooner you see that, the sooner you start getting help instead of only paying. Read the code. Hire the professionals who understand it. Invest in the areas the tax code rewards. Stop complaining about the system and start using the system. And remember, every single strategy I walked you through is 100% legal, 100% reflected in plain language across the Internal Revenue Code, and 100% available to you right now. As soon as you decide to participate instead of only observing, the IRS can be positioned to help you. You just need to learn how to ask for it. One last thing before you go. If nothing else you take from this video, take this. Every wealthy family you have ever heard about got there by understanding one thing ordinary people often never learn. They learned that money is not earned the way most people assume. It is not earned only by working harder. It is earned by positioning yourself inside the parts of the tax code that Congress subsidizes. A dollar earned through a W-2 job is taxed at a much higher effective rate. Then you spend what is left. A dollar earned through business ownership, real estate, or properly structured investments can be taxed at lower effective rates. Sometimes 0, 10, or 15% depending on the situation. Sometimes less, and then it can be reinvested and compounded for decades. That gap is what separates staying where you are from building something generational. Make the decision today. Do not wait until next year. Start with one compliant strategy, implement it, then add another and another. This is how real wealth is built. One legal tax advantage at a